Good morning, everyone. Thank you so much. Uh, Today, guys, I'm going to bring some video over here. The guy who nailed full markets will start in 2023. You are going to hear, and then you see what is going on with mining stock. So I will play a small thing, and then I'll talk more about the stock that this is going to moon because uh, let's go here. I want to show you before I recorded the video. We want to see Apple. Apple, I did video here. Apple look like we need Apple bounce back before failing, you know. And the another thing is dollar. Dollar is dumping right now, which is telling us stock is ready to bullish today, guys. We are going to moon today, so everything set up. Fix also is losing momentum also, and let's go to the video. Listen the video, guys. Remember, I better share this one for you if you didn't watch it. Can you listen?
Wrong, except for that guy. Fundstrat's Tom Lee, aka the Oracle of Optimism, aka the guy who got it right, aka Tom Lee, not the drummer. He predicted the S&P 500 would end the year at 4,750. That means that if the S&P, folks, falls just a tiny 5 points next week, we got 4 days of trading left in the year, Tom could literally be exactly right. Wouldn't that be something? So let's bring in Tom, who, you can smile. It's kind of the Tom Lee version of a smile, but you got it really right. And the basic question is how? What did you see that all these really nice, by the way, but really highly paid and really wrong strategists at the big houses got it wrong?
Hi, Brian. Thanks for that intro. I think there were two things that we were different from the street. The first is we didn't think inflation would take a decade to defeat. I think many were bracing for 10 years of Fed fighting inflation so stocks would get stuck. And the second was because of the inverted yield curve, many were predicting a hard landing in 2023. Our view was that inflation was going to fall like a rock this year, and the Fed therefore could take its foot off the fight, and that economic resilience and the fact that companies were bracing for this storm of hikes actually could avoid a recession. And so I think that kept us optimistic, and that stocks would look like 1982 and rebound to all-time highs very quickly, which it looks like it's happened.
So again, not to be little, but why did you think that inflation was going to drop? Because if that is the basis of your thesis, others also got that wrong. What did you see in the data that made you think, when things were just cooking inflation-wise at the beginning of the year, that they would slow down?
Well, Brian, it's a little. What our team did was we rejiggered inflation and identified that 86% of all this rise in core inflation was coming from housing and cars, including the fact that supercore was rising. Almost all that was auto insurance, auto repair, auto leasing. So we realized that this was all just following goods pricing, that car prices were set to fall, and that would pull down inflation. It looks like that's kicking in now, and that housing just needed to get towards a 3 to 4% annualized rate, and that would get you back to where you need to be to get to 2% core inflation. So our view is it's not about travel and it's not about health insurance. It's really about cars and housing getting back to normal, and that's the trajectory we've been seeing. I think the market's recognizing that view, but we spent most of the last 18 months arguing that view.
What are you looking at for next year, Tom?
I think it's going to feel like a lot of tailwinds coming together, because we know the Fed is going to be supportive, managing the business cycle instead of fighting inflation. And we've identified reasons for capital spending to pick up next year, including that huge gap between soft and hard data. And that should lead to EPS surprise. And then mortgage rates, we think, could drop towards low fives, maybe even fours next year. And that would be stimulative to the consumer. So to me, it feels like it could be an early cycle year that really benefits financials and small caps.
But you don't see the S&P 500 gaining another 20%, do you?
It's possible, but that's not our base case. We think it's going to gain at least 10% towards 5,200. but it probably means you first consolidate a lot of this parabolic rise in the first half. So maybe we fall to 4,300, but then we rally pretty hard into 5,200 by year end.
But you think that small caps could outperform the large caps next year? Did I hear you right?
That's right. Yeah, I think small caps might even just rise every month next year because on a price to book basis, they're back to 1999 levels relative to the S&P, and that was a launch point where small caps outperformed for 12 consecutive years. So I think we're entering a period where small caps and market breadth are going to expand, and that's going to be good for stock pickers because they can buy companies they like, and you're going to have a decent earnings backdrop as well.
Yeah, there's a lot of companies out there, and we're not allowed to own individual companies. I can own index funds and ETFs and mutual funds. That's pretty much about it. But when I look at some of these screeners that I'll do just on because I'm bored and I'm boring, I'm like, man, there's a lot of seemingly really good growth companies that are trading at like 4 times earnings in small caps.
That's right.
Really just left on the trash heap.
That's right. I mean, the money's been equities have been starved of inflows. Retail investors pulled money out of stocks this year. And in fact, the S&P ex-FANG is trading at 15 times forward earnings. I mean, that itself is a pretty reasonable multiple. But then when you look at the S&P 600, which is the small cap index, you're at 12 times. So you're absolutely right. Small caps are pretty attractive.
Are there times when you would love...
So thank you so much, guys. So you hear the small cap is going to pump 2024. That's the important thing. Full market's already started, and when you see Tesla also is a breakout, it's loading, and Tesla is already breaking out. So that's why you see something like NEO. NEO is loading right now, and this is the right time, guys, now to identify the small cap stocks, which is already down there. So NEO is breaking out. So you need, I think, if you stock, you need to watch NEO very closely. NEO, Tesla, Raytheon. So, but you need to see the other meme stock like GameStop, GameStop's course, AMC. I don't know AMC. Aaron finished AMC, so you see Raytheon still holding strong up there, and we are on bull market. So guys, when you see dollar weakness, that is very great. See the monthly cap, guys, it has a tall green candlestick, red candlestick, which is showing us we are likely to see dollar go back to $90. So thank you so much. That was the video, and have a nice day.